Focus brought to you by IG, taking a deeper look at what's been going on in a really volatile Australian dollar market that recently hit some year-to-date lows. We're going to check out the price action, but also take a look at why traders are buying this Australian dollar. What are they looking at? There might be a couple angles here, but let's start with the exposure that we've been seeing building in this Australian dollar market that's now made some new lows in the last couple of days of trading year to date, breaking that 64-cent level against US dollar. You can see they broke that a few weeks ago, but in recent trade, putting in new lows on the year. And this is a market that rallied all the way up above 70 cents to start the year, now falling from high to low around 800 pips in the last several months. And people wondering, is this the low? Is it 64? Is it 63? Well, 83% of traders at IG are long this market, hoping that 64 is the low here. And for some context, there's several hundred IG clients with open positions in this market currently, 4 out of 5 of which with positions are long that Aussie, short that US dollar, actually more than 4 out of 5 at 83% there, showing you that, of course, where people are positioned on this forex pair, or when you look at the commitment of traders report for different commodities, it doesn't necessarily prove anything, right? Theoretically, the market is still 50-50 on whether it'll go from 64 to 65 or 64 to 63. But when you see this type of overwhelming majority interest on one side, it's something to write home about. Maybe not a predictive measure, but a really interesting thing to take a look at. And I wanted to go further on what these traders might be looking at here from a price action perspective, from a more macroeconomic perspective, and from a fundamentalist perspective as well. But let's start with the price action here and widen out our lens to look at Aussie versus US dollar. For the last 2 decades, my friends, so much data given to you by IG, not only the client sentiment where people are positioned, but also just the market data going all the way back to before 2000. And what you're seeing here is that below 64 cents is quite low. There are a handful of data points lower than this, or even at these levels. And of course, your eye gravitates right towards the pandemic there. Right as the pandemic is breaking out in early 2020, Australian dollar rips through those lows, actually rips through 60 cents and lower there. This is a monthly chart, so it only traded below 60 for less than a month, bounced back the following month, and didn't really look back from that 60-65 range where we are now, until the end of last year, the peak of inflation fear. So more fear coming into the market, moving that Australian dollar lower, bringing the US dollar higher. And then you'd have to go before that all the way back to the financial crisis of '08 to see this market fall. And look at that dive that you saw in the early part to middle part of 2008, going from above 90 cents all the way down and hitting, it looks like barely touching 60 cents, not closing the month below 60 like it did during the pandemic, but trading around 60 to 65 for a few months and then climbing back in 2009 and 2010 to get all the way back to parity against the US dollar. So pretty wild move there. And then you have to go back to more than 20 years ago, go all the way back, my friends, to 2003 to see some more data points below this 60 to 65 area where we've been trading recently. So are the traders thinking that this might be just simple mean reversion, right? Like a market that over the last 20 years has traded primarily between 60 cents and a dollar, a little bit above a dollar. Now that it's down close to 60 cents, are they thinking that it's going to bounce back to a mean or somewhere in the middle, essentially around 70 or 80 cents here? Could be just a pure price action play that we have 83% of the clients on. Could also be a more fundamental play. Part of what's going on here was recently the central bank from Australia paused interest rates around 4%. And the start of the year, the market thinking that the Australian central bankers might get up to 5%, might actually get higher interest rates than the US, paused the last couple of meetings and have made allusions to maybe being done with their interest rate hikes around 4%. At the same time, you now have, an almost exact 50-50 scenario, 51-49, between the U.S. staying paused here at 5.5%, so a full percentage point higher than Australia, or they're looking at potentially another hike or two. You see the 4% chance of a 50 basis point hike or two 25 basis point hikes from the Fed, the U.S. central bank here, by the end of 2023. So maybe traders thinking that this is priced in, that this gap of interest rates between Australia and the U.S. has gotten as wide as it's going to get, and those rates might converge back. That could be part of it as well. Of course, that rubber band can expand even further. They can diverge further in the same way that from the price action angle, they can get down to 60 cents, can move lower as well. And a last piece that might be an interesting angle here for traders is, are they looking at a bounce back from China? And this might seem out of left field if you either haven't traded forex before or haven't looked at forex correlations. But Australian dollar and Chinese stocks actually have a pretty high positive correlation historically here. And you can look at the chart of the two over the course of the last 3 years or so, and you can see they're both trend lower together, both trend higher together. You see that positive correlation working out, and as you start to think about it, it makes sense, right? Australia and China, geographically close for being different continents. And also their economies are closely tied to each other. And oftentimes Australian dollar will be used as a placeholder for the Chinese currency or for Chinese stock markets as well. And to boot, Australian dollar is often considered one of the more risk-on forex pairs of the major global currencies, which is to say it can perform well when risk-on assets like stocks are performing well. But on the flip side of that, it can perform poorly when stocks are performing poorly, when risk-off is the predominant theme. Just the same way, reversely, US dollar often in recent history has performed well when stocks and risk-on assets have been performing poorly. And so are they thinking that this recent downside we've seen in Chinese stocks and Chinese economic data has been very poor the last couple of months? Has that put in a low? Are we at the peak of fear and they're going to bounce back, and maybe using that long interest as that type of idea? Who's to say? I mean, maybe it's all three of these things building in this 83% long sentiment on Australian dollar. Are they right to be long here? Only time will tell. Of course, the theoretical 50-50 of where this market goes the next day, the next month, the next year. We'll see if we get an Australian dollar bounce back. But yeah, in rarefied air here, both in price action to the downside and sentiment to the upside.